Now, the standard microeconomic model that you've studied with demand and supply can be applied to all sorts of economic markets, but one of the most interesting ones is the labour market. And in the labour market, we're looking at the way that the demand for labour and the supply of labour interact to determine the wage rate within an industry, and also the amount of labour which is being employed. So this video is going to look at labour demand and how we establish the amount of workers that a firm is going to be wanting to employ. So as always, we'll start with a definition. So what you can see here is that essentially this definition is broadly the same as definitions for demand that we've seen earlier on in the course. We're just changing a bit of terminology for some labour market specific stuff. So rather than just talking about the quantity of a good, we're talking about the quantity of labour, and rather than talking about a particular price, we're talking about a given wage rate. So when we're talking about the labour market, the wage rate is essentially, what we mean by that is the price of labour in effect. So we know that firms are going to be willing and able to employ a certain amount of workers at a given wage rate. There is another definition here which is important to think about when we are thinking about labour demand, because demand for labour is what we call a derived demand. And what we mean by that is that when firms employ workers, they don't want workers just for the sake of having workers. They want workers for the value of the products that those workers can actually produce. So the firms don't want the workers themselves, they want what it is that those workers produce, and we call that derived demand. So we can say that derived demand is when demand for one thing is as a result of demand for something else. And labour is a derived demand because the one thing is labour, so the demand for labour is as a result of demand for something else, which in this case is the output of the labour, so what the workers can actually produce. And that's what gives rise to a very key way of measuring, I suppose, the level of demand for workers. In other words, thinking about how much a firm is willing to pay to employ a particular worker. So we're going to think about a little example here, and the example we're going to use to consider this concept is making alarm clocks. So we've got this chap here who is making alarm clocks. So if you are the company that is making the alarm clocks, we need to figure out essentially how many workers you are willing to employ at a particular wage rate. And now that is going to depend on two aspects primarily. The first thing is going to be how many clocks can the next worker produce? Okay, and the other thing is going to be how much does each clock sell for? Because those two things, we should be able to see, are going to determine essentially how many workers the firm is going to be willing to employ. The more each worker is able to produce, the more clocks they're able to produce, the more the firm is going to be willing to employ at any particular wage rate. And similarly, if the clocks that they produce are much more valuable, then that means that the firm is going to be willing to employ more workers to actually produce them. Now, we've got terms for each of these things. So how many clocks can the next worker produce? Now, the idea of the next worker here should already be kind of flagging with you that we are talking about the marginal unit of labour here. So this concept is known as the marginal physical product. So the physical means how many actual items can they produce. So how many actual items can be produced by employing one additional unit of labour? That's called the marginal physical product. And how much does each clock sell for is the marginal revenue. Now, if we assume that this is a perfectly competitive market, then the marginal revenue and the average revenue will be the same. So we make life a little bit easier for ourselves there by assuming that all of these clocks that are produced are going to be sold for the same amount. So what we've got then is we've got these two concepts which determine the amount of labour that firms are willing to employ. So if we just move this up a little bit, these two items then come together in the main concept here, which is what we call the marginal revenue product. And this is what determines how many workers a firm is going to employ, or is going to be employed in an industry at a given wage rate. And it's equal to the marginal physical product multiplied by the price, or by the marginal revenue or the average revenue, because they're all the same here. So the marginal revenue product is the marginal physical product multiplied by the price. So what we can see here is that any factor which causes one or other of these two things to change is going to alter the marginal revenue product, and is therefore going to alter the amount of labour that a firm is willing to employ. So let's have a look at that on a diagram, and more importantly think about what shape this marginal revenue product curve is going to have. So here are the axes that we use in labour market diagrams. So we've got the wage rate on the vertical axis. Remember that the wage rate is basically the price of labour, so that's essentially the same thing here. And we've got the quantity of labour on the horizontal axis. I've also put on, just because it'll be useful to us to think about this concept, the formula there for the marginal revenue product, which remember is the marginal physical product, how many items are actually being produced, multiplied by the selling price. Now again, we are going to start by making things quite simple for ourselves. So we're assuming that price is remaining constant here. We're assuming that this is a perfectly competitive market. All products are sold at the same price. So we're not going to consider price change in terms of the actual drawing of the curve here. So really all we're thinking about in terms of determining the shape of the MRP curve is the MPP curve, the marginal physical product. And what we've got here as well is another really important concept that you will have covered earlier in the course, which is called diminishing marginal returns. Now, diminishing marginal returns, we first of all considered when we thought about why the PPF might be curved. But it crops up a number of times throughout the course. Diminishing marginal returns means that as you add a single factor of production, when at least one other factor of production is fixed, you start to reduce the amount of return you get from each extra unit that you add. Now that sounds quite complicated, but an easier way to think about it is if you've got a production line in a factory or whatever, the first worker that you add is going to increase output by quite a lot because it enables you to run the production line in the first place. The second worker that you add is also likely to contribute quite a lot. They are going to be making quite a sizable contribution to the production line. But as we add more and more workers, the additional output from each is going to go down. So by the time we get to, adding the 50th worker or the 100th worker or something like that, the extra output that we will gain by adding those last few workers is much, much smaller. And that's the idea of diminishing marginal returns. It occurs because essentially we create bottlenecks. So when we start adding a variable unit, in this case labour, to a fixed unit, if we're talking about the production line, that would be capital, eventually we reach bottlenecks. We reach a point where adding extra workers doesn't actually generate any benefit to us. Indeed, it may start to harm us eventually. So what that means is that our MRP curve, our MPP curve, because that's what we're looking at here, the MPP curve has a relatively distinctive shape. So what happens is, initially, what happens is that the returns start to rise as we add the extra workers, but then as we add more and more workers, we see that there is a decline in the marginal revenue product, and that's because of this diminishing marginal returns kicking in. So what happens is when we have a very low quantity of labour, the firm is willing to pay a relatively high wage in order to start employing workers, because they add a great deal to the output of our little firm. But as we add more and more workers, then the additional output that they produce is going to get less and less and less, and because the selling price is remaining constant, that means the revenue by selling the additional output will become less and less and less, and therefore the firms are going to be less willing to employ them. So if we just kind of take a couple of points here as examples, so we'll take a point here, and we'll take a point here, and we'll call this W1, and we'll call this W2, and we'll call this QL1, and we'll call this QL2. So what we've got here then, essentially, is that this means that at W1, only the workers that have a higher MRP than W1 will be employed. So what we're saying here essentially is that only the workers with an MRP which exists kind of on this bit of the line up here, so if we just kind of trace with a slightly squiggly line here, so only workers that are on that bit of the MRP curve will be employed. So only workers up to QL1 will be employed if the wage rate is W1. If, though, the wage rate is much lower, if the wage rate is W2, then we're going to have a number of extra workers who contribute enough to the revenue of the company that they're going to be employed as well. So if the wage rate is W2, we obviously get all of these people here are employed still, because they obviously have a higher MRP than the wage rate, but we also get the ones who are represented by that bit of the MRP curve, and so we also get at W2, we get workers employed all the way up to QL2. So that is the MRP curve, okay, also called the demand for labour curve. Important thing to remember, the main thing to remember there, is that the MRP curve is determined by the marginal physical product and the price. We normally consider the price to be held constant when drawing the curve, so what that means is that the MPP determines the shape of the MRP curve, and the shape of the MPP curve is itself determined by diminishing marginal returns. What we can also think about here then is a shift in this MRP curve to the right or to the left would be caused by changes in either of these two things. So we can say that a shift in MRP can be caused by either changes in the MPP, the physical product, so that might be, for instance, improvements in technology or something like that that enable the workers to actually produce more. Alternatively, it might be due to changes in the selling price of the product. In both of those cases, if they increase, then the MRP curve will shift to the right, because that will mean that the firms are going to be willing to employ more workers at the same wage rate, because more workers will have a sufficiently high MRP to justify their employment. So those things explain where we get the demand for labour from and why we draw the curve with this quite particular shape that lets us identify it. But the key thing here to remember is that the demand for labour is determined by the marginal revenue product. In other words, the demand for labour is derived from the revenue which is received by selling the goods which are produced.